Hi, I'm Kara Murphy, and this is Money with Murphy. Let's talk about volatility. Markets have been roiled of late, swinging up and down on news of tariffs and government layoffs. How worried should investors be? Well, let's break it down. First, the big picture. For much of the last 2 years, companies leading in artificial intelligence saw their stock prices soar. Remember when the Mag 7 were truly magnificent? Then, earlier this year, we highlighted two of the biggest risks that the market faced: high valuations and rising policy uncertainty. Currently, the S&P 500 is trading at about 21 times next year's earnings. That compares to the long-term average of about 16 times. By this valuation measure, the S&P is expensive, though that's typically not a very helpful timing signal. In other words, stocks can be expensive for a long time. That said, high valuations can make stocks more vulnerable to bad news. So that brings us to policy uncertainty. The new administration campaigned on the idea of change, including deregulation, tax cuts, and tariffs. The first two, deregulation and tax cuts, are generally seen as positive for the market. But excitement over those moves quickly got overwhelmed by the focus on tariffs and the whipsaw changes around those policies. Now, whether you agree with those new policies or not, markets don't like uncertainty, and large-scale shifts in Washington tend to rattle investors. The result? A tough start to the year. The S&P 500 is down over 4%, the Nasdaq is down nearly 10%, and even the mighty Magnificent Seven stocks collectively are down close to 16%. But here's the good news. This isn't a doom and gloom story. While high valuation stocks have taken a hit, not everything in the market is down. In fact, international stocks are up 9% so far this year. The consumer staples sector is up 6%, and bonds are doing their job, with the Bloomberg U.S. Aggregate Index up about 2% so far this year. Additionally, the number of advancing stocks has actually increased compared to last year. That suggests that the recent shift in the market is more rotation from one type of investment to another. That said, I realize that expecting change is very different than living through change, especially when it comes at a breakneck pace. Let's not forget, though, that corrections are a normal part of investing. Historically, markets experience a 5% dip about 3 times a year. A 10% correction happens roughly once a year, and a bear market, or a drop of 20%, occurs about every 3.5 years. And since October 2023, we haven't even had a 10% correction. So while the current decline is unsettling, it's actually not unusual. Bottom line, market downturns have and always will happen, but they don't last forever. Overall market breadth is still healthy, international stocks are outperforming, and bonds are providing stability. Volatility may be uncomfortable, but it's actually part of the ride. And history tells us that long-term investors who stay the course tend to come out ahead. So thanks for watching, and as always, invest wisely and live richly.